It's time for Cover Your Assets with Jim Lynch. Jim, of course, joins us on a Tuesday morning, and Jim is an independent voice on Wall Street, the economy, politics, sports, and he brings years of experience to those topics and more. Years, I say, folks. Good morning, Jim.
And good morning to you, Marshall, and Jill, and everybody out there. I hope you're all doing well. It'll be a pretty nice day.
Yeah, we went through 4 days of the Labor Day weekend, which we had great weather. Of course, not many events going on that you could participate in except your own socially distanced events. We had some things go on here, but it was the first 4-day Labor Day weekend that I can tell you in a long time that wasn't interrupted by rain. And, of course, because it's a pandemic, most of the events were canceled. But that's the way the ball drops every once in a while.
That's the way the cookie crumbles, isn't it? Yes. It'll pick up those crumbs. Anyhow. Let's see. I mean, God, there's hardly anything to talk about today. But let me start. Let me start with the stock market, which I've been bearish on it over the months now, and it's gone the other way, courtesy of very cheap money and people, I think, getting overly optimistic that the pandemic will be solved and everything, et cetera, et cetera. The point is the Dow Jones average is back to around where it was at the high. So if you sold now, I really don't think you're going to miss anything because the market was already tottering at the higher level. And it's obvious now we're in recession, and from professional people like at the Fed and economists and pretty high-profile asset managers, this market's just overvalued. And I don't know, maybe people are staying home too much and have nothing better to do than to follow the market or do, et cetera. It's not a market for the uninitiated. It's not a market to trade for people who do not have counsel. So I would lower my risk profile dramatically, whatever that means for you. I can't get into specifics because I don't want to mislead people who have some type of portfolio that doesn't apply to. But it's quite obvious from what happened last week that the high flyers, the Apples, the Googles, and so forth, got way ahead of themselves, and they took a pretty dramatic hit. I would expect that to continue this September, September being a very difficult month for the stock market historically, because people have loads of profits in these stocks. And, you just got to get the rose-colored glasses off. There is, Jack and the Beanstalk and all that stuff. How high does it grow? So, bottom line, very conservative. Lower your risk tolerance. Watch out for what you're doing in any area, including buying anything and committing to anything where there's an interest rate attached. Only thing you buy where there's an interest rate attached is something that the interest rate is yours until you want to change it, and it's not subject to an adjustment by a bank or an insurance company.
When you talk about the stock market, someone and I don't know who it was. I might have been even on BBC America, but somebody was talking about the economy. And for once, there was it couldn't have been a mainstream network, either Fox or CNN or MSNBC or CBS, because the report took about 6.5 to 8 minutes. So it must have been BBC America that I was watching, or maybe it was on C-SPAN. But there was an economic expert talking. And what this expert said, which I think most Americans don't know or understand, is that when you look at the economy, you don't look at the stock market as the indicator, because the stock market is only an indicator to people and to business, and people don't understand the money that government puts into the stock market to keep it afloat, that you can't look at the stock market as how the economy is going. That's why this is one of the few presidents that really keeps touting the stock market about the economy, and that there this recovery that we are undergoing is more, it's not like a normal recovery where you see one line that goes in up and down and up and down and up and down. There is a line for the stock market which goes up, massive drops, up, massive drops, massive up, and then there's the other line which deals with America's living expenses, the cost of living, the number of jobs, lost, the number of jobs gained, and that line is totally different than the line you see on the stock market. And it was an interesting report, and more people should see it, understand that the wild swings they see in the stock market show nothing about the true economy. What you have to look at the true economy is the fact we gained almost 1 million jobs last month, but we're still 10 million short of where we were before this pandemic started. So, I mean, you have to look at the stock market in a totally different way. Unless you're a stock market whiz and you're involved in it on a day-to-day basis, if you're just a normal person that has stocks and that counts on those stocks to get returned, don't look at the stock market as an indicator of the economy.
Well, most people, most people who are, Jim's point about there are people to whom this does not apply, who are invested, who have their portfolios, and who don't look at it as a daily, like the weather forecast. The situation, what I am watching with interest right this second, and I set you both things around that because there has been a pretty sizable influx of people who have been using the market as a poker. This happens. It's pretty much a regular occurrence. And there's a place where it gets really, really frothy, and people who simply don't know anybody. There's an entire generation who is really used to betting and doing things online, and they have had a basically straight line up. And now it is entirely possible that that they're getting a haircut. Those who weren't smart enough to get their money off the table. And what I'm really looking at, and Jim, I'd like your opinion about this, is now that we've got sports to bet on again, now that we've got some college football, now that we've got NFL starting, etc., it is, in my view, quite likely that a lot of people who have been using particularly the NASDAQ as their poker game are going to evaporate.
That's an excellent point you made at the end. I mean, the point was a good one, period. But, people have been very focused on the NASDAQ, which are the high flyers I mentioned earlier. And it's like there was something that occurred in Holland many years ago. It was called the Tulip Mania. And I remember an old boss of mine, God love him, Lou Glucksman, when I first showed up at Lehman, he gave me that book, the big book, a fascinating book. But it shows you exactly how crazy people can get. It's stimulated enough by people I know, people I don't know, the need to get into something which is going great, and they don't want to be left out. Oh, are you in the market? Oh, God, no, I couldn't get it. They don't want that. So they just pile in. The tulips thing was insane. Can you imagine? All the money spent on tulips.
I personally,
I don't even think you can eat tulips.
No. My personal favorite, however, and I did include this because it's so far away that no one would ever know. It was the South Sea Land Company. It had a wonderful name, but it didn't end well because there was nothing there. And what happens when when people get all excited. It's manias, panics, and crashes. The word mania has been in use, by the way, for years and years and years. It's not just a psychological term. Or maybe
yes, and it's interesting because the first time I heard mania in the last several months was your voice right now. People are really not, they're not focused, that's too general. The so-called experts are not getting into this just on a professional basis to say, well, is this a mania? Why is this happening? You also raised the NASDAQ as where people are focusing. Because if you look at the Dow, many Dow stocks in various industries, they really haven't moved as much because they're more long-term oriented. Long-term, the economy putters along and does better each year and so forth. Those are the kind of stocks that people normally buy, and they do work out over a period of time. But when you get into the NASDAQ and you see stocks going up 30% in a couple of weeks, there's something wrong. There's something wrong.
And when you see, I'm sorry to interrupt, but when you see there's a guy, and he's I'm not going to use his name, but when you see him, he's in his early 40s or his late 30s or whatever, and he's had some real success. But when he's like, I made this should be a red flag, and it never is. I made $600,000 this week. Just sitting here doing nothing. I don't understand why people don't do it.
Yeah, the only thing that I'm going to chip in as being a broadcast professional is, and broadcast ratings are a lot like the stock market. And I'm going to put it this way: there are lots of radio stations who sell year to year on the success in their ratings. I was taught by some very wise sales managers and general managers over the years that those who live by the sword die by the sword. And the stock market is a lot like that, and it's, in my interpretation, is that what we look at when we look at ratings in broadcasting, we look for long-term growth, which means you're up 2% one year, down 1%, up 2% another year, maybe down 1%, up 3%, down 2%. But you look at the graph, and you know that you're keeping your steady audience and that you're slowly growing. The radio stations that sell the book when they have a great book, which is what it's called, and they sell the heck out of it. Well, the next time the book comes out in 12 to 16 weeks, guess what? 9 times out of 10, you're not there, and all of a sudden you have nothing to sell. So I guess what I try to explain to people is that it's not monetary, but figures to figures. The stock market, to me, compares to broadcast ratings the exact same way. You look at, if you're going to go into it, look at it into long-term growth, where you're starting and where you want to end up. Don't look at it as on a month to month, 6 months to 6 months. Don't look at it on a rating period, because if that's the case, you're going to lose your shirt and you're going to lose your mind.
Quite right. And, again, there are some younger people who have a longer term horizon, and they, you just can't lump in. It's unwise to lump in people who are speculating with people who are investing, and it's a massive difference that doesn't get it's a difference that doesn't get enough play, credit, acknowledgement is all I am saying. And for most people who are just watching the numbers all day, and there's a reason that it's set up like that, and it's now totally, this used to be the province of traders only, but now anybody has, they're sold. And by the way, for people who have been buying their stocks by the slice, etc., that's going to be an idea whose time has come. I'm sorry, I shouldn't say that. People really need to also delineate the difference between an opportunity to spend money for a brokerage, in other words, where you are, of course, not paying fees because no one charges you fees, but you've got this transaction, something charge, lots of little charges where, let's just say that most brokerages don't give you something for nothing. You think that's fair, Jim?
That's very fair.
So I just
Back to what? Go ahead.
no, please.
Back to what Marshall said in terms of his analogy of the radio success vis-a-vis the market as it currently is. The word that comes up is long term. We were taught when we were younger, as Marshall will say, much younger, that the way you invest in the stock market is you have to have a time horizon. You buy good stocks, and you hold them for X amount of time as you watch the business develop. And it requires a certain discipline. But the most successful people, average people, I'm not talking about these guys who run $1 billion with assets, is buy and hold. So when you buy something which is not overpriced. Maybe you can get something underpriced vis-a-vis the price-earnings ratio and stuff like that. But the idea is just buy something that you know is going to be around. People are going to want to buy. Corporations are going to need in their factories or whatever. And just hold them. Hold them for how long? Maybe 5 years, maybe 10 years. Now, that, unfortunately, right now is a very difficult thing to grasp. But if somebody is really interested in being successful in the market, they really have to look back at the charts. And the charts are very simple that will show you. You can look at the general chart of the Dow or the S&P 500. These things go up. As Marshall was saying, they slip a little bit. They go up. They slip a little bit. But if you're in a good company in the 5 years we're talking about, they will be much better. How much better? Who knows? But they'll be much better. Your money will be intact. You'll have dividends and so forth. So it's very difficult. Again, I understand that. Human nature is into the quick fix, is into the drama, no matter what it is. Even with money, I can't tell you some of the stories that I've seen people, and the 2000 debacle was one of them, where with a particular client, I had very successfully done what was appropriate in making money, maybe did a little more trading than I would normally in these high flyers. But then it reached a point where I was through. I was out. Client calls, oh, I got to have, it was Cisco, as I remember. I got to have this. Give me some, buy me an odd lot or something. So I did at about 90. And the damn thing bottomed out at about 10. But no offense to that person, okay? Just caught up in the groundswell. This is human nature. But this is why discipline is required. And if you don't have the discipline, if you're going to be impatient, if you're going to check your broker every 10 minutes, how's the stock doing? Forget about it. Stocks are not for you. Stocks are long-term investments all the time. You look at the performance of Warren Buffett's fund. That man buys big, holds long, been very successful. That would be your model, in my opinion.
To me, day traders were to the stock market what Facebook is to news. It totally distorted the situation, and allowed people who had no business doing what they're doing, trying to do what they're doing.
No question about it.
Genius.
No question about it. And it feeds on itself.
Yep.
Just like Facebook.
Yep.
With these things they put out. It feeds, and somebody else drops a lot of baloney on the Facebook as well. So let me make this one point before I forget. It's very, 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 very important at this time. One thing that the experts are beginning to talk about is the volatility in the stock market. Yes, it's going up, but they're finding, as shown by something called the VIX, VIX index, that the volatility of people trading and moving around is growing much greater than the potential growth in earnings of the given stocks. Not the stocks themselves, but the earnings, the underlying. This has been traditionally a sign of it's time to get off the ship. And VIX is something you can look up. If you know, it's not hard to understand, but you need to look it up and read about it and think about it and talk to somebody. It's that kind of. Well, it's not that complicated. So VIX, VIX. Anyhow, the sell signal is there. The market is way overdue, and September historically has been a rather bad month for the stock market generally. Why? It's seasonal. People come back from vacation. They want to adjust their portfolios. They say, oh, Christmas is coming. Oh, I want to take the winter trip. Let me get some cash. That's probably simplistic, but this is how this goes, this seasonality thing.
All right, guess what?
Don't tell me.
We've
Don't break my heart again.
We've punched the clock and run out of time.
And you haven't done sports. I don't know what's the matter with you guys.
Let's ring the bell. Ring the bell of freedom.
All right, Jim.
All right.
Okay, gang.
Take care. We'll see you next week. Jim,
got it.
All right.
Bye.
Jim Lynch and Cover Your Assets here on Robin Hood Radio.